Testing. All right, now there's audio. That's a bummer. Thank you, Jay, for letting me know because I just had like the best introduction ever in my effing live stream, and there's no goddamn effing sound. If you can hear me now, let me know. But I am PO'd. All right, thank you, buddy. Jay says it works now. All right, so I feel like I have to start this whole. I can't say the out and out F word on the live stream, or else my compliance people will have an effing fit. But I am so goddamn angry right now that the sound didn't. I don't know why the sound didn't work. I didn't change a thing. I didn't click on anything, and it's been so good for so long I didn't bother checking it. But the buck stops here, so I have to take blame for it. Just a reminder, I'm supposed to check the audio. God damn it. All right. So what happened today? Dow down 1,000 points. So we're going to do a quick impromptu live stream. I always say I normally don't do these live streams on Fridays unless there's a market calamity, unless the market goes down a whole hell of a lot, like 1,000 points in the Dow. That's exactly what happened today. So we have our down day in the market, big down day. Why? Chairman Powell, the chairman of the Federal Reserve, comes out and says some very hawkish things. And when I say hawkish, what does hawkish mean? Hawkish means the Fed is going to be much more stringent, much more with much more gusto to slow down the economy, to tamp down inflation. We saw a new and different side of Powell. Jerome Powell, chairman of the Federal Reserve, has for the longest time been a very gentle, kind soul to labor. He has consistently said that I don't want to throw people at work. I want more people to become employed. I want to see minority unemployment go down also. So I want to keep pushing the pedal to the metal. All right. And think of it this way. If he keeps interest rates low, what does it do? So let's say if you're a business and you can borrow $1 million at X interest rates, you're going to pay a certain amount of money every year in interest to borrow $1 million. And with that $1 million, as a business, you might buy more equipment, more trucks, hire more people, rent more space, build another building. There's a couple things you could do, a lot of things you could do with $1 million. But if I lower interest rates, as the Powell, so I'm Jerome Powell, and if I lower interest rates for the same amount of money every year that you're going to pay in interest, the same dollar amount, maybe you could borrow $1.4 million. That's a huge amount. That's an extra $400,000. Now, if you do that with corporations who borrow hundreds of millions of dollars and billions of dollars, and consumers who might take a mortgage for $300,000 might not take a mortgage for $500,000 because it costs the same in the monthly payment, you could see that people can spend more because they could borrow a lot more for the same amount of interest cost. I'm not talking the interest rate. I'm talking about the dollar amount that they pay in interest, okay? Very stimulative to the economy. People buy more shit. That's just the way it goes. It's good for the economy. More people work. We import more. We manufacture more. It does all kinds of wonderful things for the economy until inflation starts to go up too much. Now, Powell, who's been very kind to investors, very kind to labor, a very gentle Federal Reserve chairman, you saw a new guy today. Almost like we didn't recognize him. He comes into Jackson Hole with a speech, which these are usually long speeches from Federal Reserve chairman. Every year at Jackson Hole, this big meeting in a town called Jackson Hole in Wyoming. And if he comes out today and says, I'm going to just talk for a couple minutes, I'm going to be very direct with you. He delivers an 8-minute speech, which is like, whoa, 8 minutes, that's it. And he basically says, yeah, there's going to be pain, and it's going to be felt by consumers and businesses alike. But the only thing worse than that is if we don't have price stability. If you don't have price stability, the economy works for no one. And that's going to be worse than me crushing the economy with higher interest rates. I mean, this is a completely different person than we've ever seen before with Chairman Jerome Powell of the Federal Reserve. Just a totally different ballgame. And I think it's a big shock to the system. Okay, that's what happened. So for investors who thought, and I want you to know, we talk about this. I was one of them who thought that we were past the halfway mark between the beginning of the Fed raising rates and the end of the Fed raising rates. We're maybe now at the halfway mark, maybe not even up to the halfway mark. All right. Another way I would describe this is Chairman Powell had his Volcker moment. Now, Paul Volcker was the Federal Reserve Chairman. I think he came in 1980, late 79 or 80. And the economy was in bad shape, U.S. economy in the 70s. We went from boom and bust. We had a number of recessions. Looking back, it's clear that the economy was never really that good at any point in the 70s. We had a couple of up economies, but they weren't long lasting. And what happened in the 70s when there was inflation, the chairman of the Federal Reserve, I forget the name at the moment, he raised rates to slow the economy down. And when he saw the economy slowing down and a recession or heading into a recession, they would cut rates. And what would happen is very quickly, inflation came right back, even more virulent, stronger than it was before. So when Volcker came in around 1980, he jacked up interest rates, 80, 81, started to cut them at 82. He didn't just jack them up and wait. We had two recessions in the early 80s. I think there's one in like early 81 and one in 82, back-to-back recessions. He didn't chicken out and get scared. He kept the pedal to the metal and kept interest rates high because he didn't want to make the mistake that his predecessor made in terms of letting inflation get out of control by cutting rates, because every time you think you're going through recession, chicken out, lower rates. Volcker said, we're just going to raise rates. We're going to front load the interest rate hikes. So the economy down. That's what Powell's doing now. He's having his Volcker moment. He has already raised rates 4 times this year. 2 of which were 75 basis point hikes. That's 0.75%. Usually the Fed raises 0.25%. So if the Fed raises 0.75%, it's like 3 meetings worth of rate hikes in one meeting. He did that twice, and it's expected that next month, okay, late September, he's going to raise rates 0.5% or 0.75%. We could debate which one it is. I think it's meaningless. 50 basis points or 75 basis points. The point is he's going to raise rates. He's going to raise rates for longer and more often than investors expected. That's what threw the market off today. And he wants to make sure he raises rates a real lot now to get ahead of inflation. He's already behind it, but to tamp inflation down and to let investors know, I'm not going to just, raise rates, and if the economy weakens a little bit, I'm going to go soft and then stop raising rates or even cut rates, which is what we all expected, because that's what we've always gotten from Powell in terms of being a gentle Federal Reserve Chairman. Now he's saying, I'm going to front load the rates because I want to really slow the economy down fast and furious. I want to do it now. And I don't want to cut rates or stop raising rates too soon because I don't want inflation to go down a little bit and then come back even higher than it was before. Okay, it's like getting over a really bad cold and then you have a rebound and it rebounds even worse than before. So that, my friends, is exactly what happened. Okay, the stock market right now, as far as the S&P 500 goes, by the way, you can't invest directly into an index like the S&P 500, but you could invest in a security that tracks or mimics an index like the S&P 500. Okay. S&P still has about half of its gains from the June low. Just want you to know. The market was probably too low in June, which obviously is why it bounced back. It was too high about 2 weeks ago. The market was too high. The rebound was maybe too much. So my thinking is we could be somewhere in that direction, which would be about where we are now. I think it's pure speculation, and I think you are worth more than watching me take the time to speculate on where it goes. Okay, Jay says Greenspan. Well, Greenspan came after Volcker. I was thinking of the chairman who came before Volcker. I just forgot the name. I know it. I've said it before. But Greenspan came after Volcker. Okay, then after Greenspan was Bernanke, then Yellen, and then Powell. Right? Maybe you misunderstood my question. Maybe I said it wrong. I don't know. Feel free to correct me. Okay. Okay. Um, Volcker raised rates when he became chairman, and he raised rates. You don't remember either? Well, we're old. Well, we should be old enough to remember. How about that? But we were little. Do you think in 1980 I gave a crap about who the chairman of the Federal Reserve was? In 1980, I was 13 years old, and I was more interested in another topic than I was in interest rates. Okay, and you were probably the same way. So let's just get back to that. All right. So when Volcker raised rates, he went pedal to the metal raising rates for 2 years. I don't think investors are prepared to see Powell raise rates for 2 years. It's been about 6-7 months now since he raised rates. I don't think people were looking that far ahead for him to keep rates so high. Right now, I don't think he has to keep raising rates for 2 years because inflation is not as high as it was in the 70s. It looks like he is more determined to get ahead of inflation. Okay, he's to get ahead of the inflation before it becomes what it was in 1980. We had like 15% inflation. We had interest rates, short-term interest rates were 15 or 16% at the time, super high. Like if we had that today, imagine what the value of houses and the stock market would go down to. All right. I think at the end of the day, I just have my notes here. At the end of the day, I think what investors are going to really value is a Federal Reserve chairman with a strong hand. And that's what we're not used to. We've had from Bernanke to Yellen to Powell, we've had a succession of chairpersons of the Federal Reserve who were data dependent. And they said, well, if the economy is getting stronger, we could raise rates. If it starts to get weaker, we'll lower rates. And we're just following the economy around, as opposed to now Powell saying, I'm not going to be data dependent. I'm going to raise rates, and I'm not going to react to every month or every quarter of data that comes out. We're going to really lower inflation, and this could take a couple of quarters, maybe a year, maybe more. It's such a sea change in terms of what we've seen. So Powell is resolute, and I want to remind you, though, what do you do as an investor? Because if you're watching me now, you're watching me now and you're an investor. Couple things to keep in mind. We're still long-term investors. I don't worry so much about the market. I really don't. People think, oh, you must be watching the market so volatile this year, so choppy this year. Your clients must be going like crazy. You must be going nuts with it. Must be, must be scaring you, or you must be down in the dumps. No, none of that. Personally and for clients, we have an emergency fund. We have money set aside for planned expenses. You're buying a boat, you're buying something, you have a balloon payment coming up for your commercial property coming up. We're prepared for these things. So we don't have to sell our stocks, our exchange traded funds, our mutual funds into a down market. Because then what happens is you have to sell even more shares to raise the same amount of money, which makes it even harder to recover in an up market. That's something called the negative sequence of returns. We won't get into that specifically now, but we want to avoid that. Okay. So long-term investing, cash for emergency and planned expenses already on the sideline, even a little buffer above and beyond that, because there's always something that's not an emergency, but nevertheless unplanned that comes up. We all know that. We all have life experience in that. The next thing to understand is that sometimes Stocks don't recover. The stock market always recovers. And I think this confuses investors when you hear, oh, but the stock market always has recovered. It's always recovered from every bear market, from every dip. But it doesn't placate a lot of people because a lot of people are in individual stocks. So let me say that individual stocks don't always recover. But the stock market averages have always recovered and gone on to new highs. So it's really important for you to know what kind of investor you are. You don't really find out what kind of investor you are until we go into a really tough market like we're in now. You don't know, and you don't know yourself until you've been through hard times. That's, I think we can all agree on that. And anyone with a life experience, such as myself, such as my friend Jay, who's such a good guy and has a lot of life experience like me, because he said right there, we are old. Okay, you said it. I got you in writing, man. You can't get out of it. LOL. Um, that we have to know our risk tolerance. So that's really about it. We saw a different Federal Reserve Chairman Jerome Powell today. This guy took his fangs out. He specifically said some pain. I just want to show you exactly what he said. Okay. All right. Now my camera forward of my screen is not going out. Here's what he said. He said, well, higher interest rates, I'll go to camera 2 though. Okay. He said, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses, he said in prepared remarks. These are the unfortunate costs of reducing inflation. Holy shit. But a failure to restore price stability would mean far greater pain. Okay, guys, things are going to be a little tougher going forward than expected. It makes a difference, and this is what set people off. I will say the volume is incredibly light today. I'm in a suburban office complex about 30 miles outside of Midtown Manhattan on Long Island. And I can tell you that the parking lot is empty. There's like 3 cars in the parking lot in a big office building. My car is one of them. And then I feel like I'm going to see a tumbleweed blow across the parking lot any second. So there is a very low volume. And I don't know if that makes you feel better or not, but that's about it for today. So Dow down 1,000 points, NASDAQ down about 500 points, which is almost 4%. S&P down over 3%, down 140 points. Gold was down. Oil was up a drop. But basically, all 11 major sectors of the economy were down, and the VIX popped up to above 25. All right. I will see you guys on Monday. Thanks so much for watching. If you have any questions, any concerns about your own portfolio, your own situation, you want to know what you should do because it's about personal finance, not just about finance, you are welcome to reach out to me. We'll have a conversation and we'll see what we need to do next. All right. Thanks and have a great weekend. Bye.